Welcome back to the deep dive. Today, our mission is to really distill a pretty complex and rapid-fire set of predictions for 2026. We want to give you that shortcut to understanding the major shifts coming in geopolitics, economics, and, big business trends.
Yeah, and this is a really high-stakes roundup we're looking at. These forecasts are critical. They show exactly where capital and, I think, policy are about to pivot. So we're going to break down the political catalysts, the surprisingly aggressive economic outlook, and the tech disruptions that are set to reshape everything.
Okay, let's just jump right in. The most immediate political saga has to be the California wealth tax proposal and the wealth exodus that it's already starting to cause. This isn't theoretical anymore, is it?
Not at all. It's happening now. The source material points to several really high-profile moves, specifically David S. moving to Texas. And he finalized his residency in December, got a new office lease in Austin for his company. It's official.
And the welcome he got was something else. You had Governor Abbott, Michael Dell, Ted Cruz, all of them publicly rolling out the welcome mat.
It's a huge signal. It shows just how much other states, especially Texas, are ready to capitalize on what they see as California's policy risk.
So what are we talking about in terms of the financial impact for California? The numbers are kind of staggering.
They are. The estimate, and it's a rough estimate, focuses on just 25 individuals who've left. And based on just those 25, the net worth that has departed California is around $500 billion.
$500 billion? That just sounds like a political number. How reliable is that, really?
It's definitely an estimate, but it shows you the sheer concentration of wealth there. And look, even if that number is inflated by, say, 20%, it's still a massive, massive structural problem for the state budget.
Especially when your tax base is shrinking, but the demand for services is not.
Exactly.
And it's not just the amount of the tax, right? It's the way the tax itself is designed that's forcing people out. It creates this profound risk, especially for founders.
It does. For an entrepreneur, this proposed asset tax means paying 5% of their company's value every year. And that's regardless of whether they've sold a single share.
So you're holding illiquid stock.
Right. Shares in a private company you literally can't sell. And you get this huge tax bill. Then what if the company's valuation drops to zero next year? You've been taxed on phantom wealth, but you still owe that original massive tax bill. It could easily bankrupt you.
And it gets even worse if you hold supervoting stock. The calculation there it's incredibly punitive.
Oh, it's designed to be. Your asset value isn't based on what you could actually sell your shares for. Instead, they multiply your total voting power by the company's entire market cap.
So the example they use is Larry and Sergey from Google.
Yes, the perfect example. Together they have, around 52% of Google's voting power? So a 5% tax on them doesn't just apply to their share of the company. Because of that calculation, it balloons into something like a 25 to 50% tax on their entire net worth.
Because they're deemed to own the value represented by their voting control.
Precisely. It becomes financially impossible. They'd have to sell way more stock than the tax bill just to cover the tax and the capital gains from the sale itself.
So that's the real catalyst, that structural impossibility. What's the political timeline looking like?
It's moving fast. Proponents need about 850,000 signatures. It could be on the ballot as early as April, with the election in November. And then, of course, you'll have immediate legal challenges, no doubt about that.
Has the market priced this in at all?
It has. The poly market prediction for it making the ballot spiked right after this got a lot of attention. It's trading high, though lightly.
Yeah.
The risk is just too great for many of these individuals to stay and see what happens.
So this migration is really just one symptom of a much deeper political shift. Let's zoom out and look at the broader landscape, the predicted winners and losers for 2026.
Yeah, if you look at the trajectory of power, what you're seeing is this continued aggressive consolidation by progressives within the Democratic Party base.
Okay, so who are the predicted political winners here? The first one listed is the DSA, the Democratic Socialists of America.
Right. The forecast is that the DSA will essentially take over the Democratic Party's institutional base. It's very similar to the MGA movement's consolidation strategy on the Republican side. They're not just focused on federal races. They're winning local elections, focusing on things like housing, zoning, municipal spending, building power from the ground up.
And that pressure forces the moderates to move left just to survive their own primaries.
That's the key. It forces them to tack sharply left.
Okay, winner number 2 is labeled the Trump boom. This is less about policy and more about sort of economic tailwinds.
Exactly. You're looking at some really robust economic numbers. Q3 GDP growth was 4.3%. Core CPI is stabilizing. And for anyone who doesn't follow this closely, core CPI is important because it removes volatile things like food and energy, so you see the real underlying inflation trend.
And the prediction is that falling mortgage costs plus big tax refunds in the spring
right, from larger standard deductions. It all combines to create this sense of economic optimism right as the political season is really heating up.
Which creates a perfect lane for the third predicted winner, Mandami.
Precisely. As the mainstream Democratic Party is seen as pivoting full socialist, Mandami gains traction by zeroing in on working-class issues. We're talking housing affordability, the cost of services, things that both parties have kind of failed to address. The source notes that net disapproval for Trump on the economy is still high, around 58%, so there's a huge opening there.
Okay, now for the flip side. Who are the big political losers for 2026?
Well, the biggest is probably Democratic centrism. There are just fewer and fewer genuinely competitive House districts. So the only real threat to an incumbent is from a primary challenger on their flank. So everyone is moving left to protect themselves from an AOC-style challenge. The center is, for all practical purposes, vanishing.
This next one was fascinating to me, the Monroe Doctrine. The prediction is that it's basically dead?
It is. The source suggests it's being replaced by a Trump doctrine. This new doctrine is all about a narrow focus on hemispheric dominance, purely transactional relationships, and aggressive economic unilateralism.
So proactive intervention, but without the nation-building part.
Yes. The example they cited was a flawless 3-hour operation in Venezuela. Get in, get the job done, and get out immediately. No occupation.
And the final loser, the tech industry. Predicted to be a lightning rod for populism on both sides.
Yeah, tech is in a tough spot. From the left, you have the wealth tax threat we just talked about. From the populist right, there's still this deep anger over censorship and deplatforming. What's really interesting, though, is a potential alliance. Some Republican senators were saying their frustration wasn't about breaking up big tech, but more about getting an apology.
So if tech leaders pivot to focusing purely on property rights,
they might just forge a working alliance with the Medjay base. It's a possibility.
Okay, that sets the political stage. Now let's get to the engine behind all of this, the economic outlook. And the forecast is for a surprisingly robust, well, an almost unbelievable economic boom.
The foundation is already strong. We mentioned the 4.3% Q3 GDP, core CPI at 2.6, and the lowest trade deficit since 2009. But the high-end predictions for 2026 GDP growth, they're, frankly, as the source says, outrageous for a mature democracy. We're talking 4.6 to 6.2%.
6% GDP growth. That's,
yeah.
I mean, that's wild for the U.S. You usually see that in centrally planned economies during a massive infrastructure push, not here.
It speaks to a huge underlying momentum. And to give you an idea of how fast this is moving, the Atlanta Fed's forecast for Q4 GDP just surged. It went from 2.7% to 5.4%.
Wow.
That kind of revision, almost doubling overnight, that tells you something big is happening.
And this optimism flows directly into the asset predictions. So what are the best performing assets for 2026?
First up, critical metals, especially copper. It's projected to be parabolic. And this isn't just a cyclical thing, it's structural. The world is on track to be short 70% of the global supply by 2040. You need copper for everything.
Yeah.
Data centers, chips, weapon systems. It's now a core national security asset.
Okay, on the corporate side, the prediction is really bold. Amazon is the biggest winner, achieving the first corporate singularity.
Right, and the singularity they're talking about isn't some sci-fi AI, it's operational. The prediction is that Amazon will have more robots than human employees driving its bottom line. This is all powered by their massive investment in same-day delivery, putting warehouses just outside every major city. That robotic efficiency is the next big growth driver.
They're also expecting a huge year for IPOs.
Yes, a massive reversal of the trend of shrinking public companies. We could see trillions in new market cap. SpaceX, Stripe, Anthropic, OpenAI, they're all on the short list to file. It could totally reshape the major nexus.
And the last winner. We need to define this term, assets that qualify for accelerated depreciation.
Right. Accelerated depreciation is a huge tax incentive. It's an accounting tool that lets businesses write off 100% of the cost of big equipment purchases in the first year, instead of spreading it out over many years. So it's a massive, immediate cash incentive to buy things like planes, tractors, industrial generators. It's fueling the U.S. infrastructure build-out.
Let's pivot to the other side. Areas of risk and contraction, starting with something we already saw last year, the struggle in enterprise SaaS.
Yes, companies like ServiceNow down 30%, Workday down 18%. That pain is expected to deepen for some. The first predicted worst performer for 2026 is California luxury real estate. The wealth tax overhang is a huge factor. It's also compounded by existing high luxury taxes in LA and San Francisco that are just freezing the market. Sellers won't drop their price, and buyers refuse to pay the tax.
Also on the list, hydrocarbons.
The source is pretty blunt on this one. The trend is inexorable and down. They're predicting oil will be closer to $45 a barrel than $65. And the reason is the unstoppable twin trends of electrification and grid-scale energy storage. Those two things are just shrinking the places where oil is even necessary.
Okay, and the third major loser is a concept, the software industrial complex. What exactly do we mean by that?
We're talking about the legacy licensed SaaS market. It's a $3 to $4 trillion industry where maybe 90% of the revenue comes from maintenance and migration, all the work required to keep old, clunky systems running.
And that specific revenue stream is what's under threat.
It's ripe for disruption. New AI models and agents can handle that kind of repeatable, high-cost maintenance work at a tiny fraction of the cost. That whole economic model for legacy software companies is about to contract and contract aggressively.
Finally, the US dollar is listed as being challenged.
Yes, challenged by unabated debt growth, another $2 trillion estimated this year, and increased military spending. It just raises questions about the dollar's value relative to hard assets.
Okay, before we leave assets, let's touch on the most contrarian beliefs. First, that AI will actually increase demand for knowledge workers.
This is based on something called Jevons paradox. It's an economic principle that says when the cost of using a resource goes down, the total demand for it actually goes up because people find new ways to use it.
So if AI makes writing code cheaper, we don't just write less code. We write massively more code for things we couldn't afford to before.
Exactly. The argument is that the job loss narrative is just wrong. This efficiency will lead to a geometric increase in consumption, which means you need even more knowledge workers, managers, editors, prompt engineers to handle all the new output.
The other big contrarian take is about Elon Musk's companies.
The prediction here is that instead of an IPO, SpaceX will reverse merge into Tesla. This would consolidate his two biggest assets onto a single cap table, giving him maximum flexibility and control.
Okay, shifting gears now to how business deals get done. The source says traditional M&A for large transactions is effectively dead.
It is. The global antitrust scrutiny is just too intense. The Microsoft and Activision deal took 2 years. No one wants to go through that. So the workaround is these massive IP license deals. We're seeing huge multi-billion-dollar agreements like Google with Character AI or NVIDIA with Grok. They're basically replacing M&A. It gives them faster access to talent and IP, and speed is now more important than the slightly less perfect tax treatment.
And finally, let's look at media and cultural trends. The dominant force predicted here is the rise of citizen journalism and exposés.
It's a really powerful decentralized trend. These aren't just observers anymore. They're aggressively seeking out stories, scandals, and crucially, they have real ways to monetize now. Substack, YouTube, X revenue sharing. It's a viable career path.
The prime example being those First Amendment auditors who film their interactions with police. That kind of high-stakes, real-world tension is incredibly compelling content.
It is. We also got one singular major entertainment prediction. The new Christopher Nolan movie, The Odyssey. We'll see if that lands as big as the 6% GDP forecast.
So after all of that, what's the big takeaway for you, the listener, looking at 2026?
The central theme, the idea that unites all of these predictions, the political migration, the trade policies, the economic growth, is this definitive shift toward unilateralism and national economic resilience. That has to be the new framework you use to evaluate every risk and every opportunity going forward. Globalism is out, national self-reliance is in.
And as we've talked about these big financial challenges, from the software industrial complex to state governments, let me leave you with a final thought to consider. If leaders in some states are explicitly prohibiting independent audits of massive government spending programs, like we've seen with homeless spending, what does that secrecy tell you about the true, undisclosed scale of their other liabilities? Specifically, think about the unrealized pension obligations that are set to hit the fan in almost every state.